Welcome, everybody. Super excited to be with y'all one more time talking about everything that's going on around metals. And we got some really cool, exciting news about what's been launched, things that are now available to the public. Long time coming, kind of excited to finally be able to kind of let the cat out of the bag and have a discussion all about it. Ben, would love to kick off with some introductions, get everybody here up to speed as far as who's who, and would love to kick it off with you.
Yeah, sounds great. Thanks, Action, for hosting. Ben Elvidge, I lead all the stuff that we do on metals.io. Previously was focused on uranium.io, but we broadened that out in March of this year, and really excited to be here talking about the next two metals that we added to metals.io last week. And yeah, just looking forward to digging into why those metals and what we see coming, and why this is a really exciting time to be in hard assets and commodities, and how that fits into the wider digital asset and RWA space as well. So it should be a really interesting conversation today.
Beautiful, man. Yeah, I cannot wait. And you are not just by yourself here today. You got some legends of the space actually right alongside of you. Tim, would you mind giving us a little intro about yourself?
Yeah, my pleasure. Thanks for that. I've been in the kind of capital markets for about 30 years now, and kind of concentrating more on commodities for the last 20 of those. And looking originally from the securities point of view, but more recently from the digital point of view. So just bringing a bit of my knowledge on, the physical metals, custody, etc., to metals.io, and very, very pleased and excited to be involved.
Oh, it's a pleasure having you here. Yeah, not all RWAs are created the same. And George, let me go over to you with that because you're in the tokenization game, right?
Indeed, we are. Yeah, thank you for that. So, George Kapp, head of corporate development at Archax. So we're a London-based FCA-regulated custodian, broker, and exchange in the sort of tokenization RWA space. So really spanning the sort of full digital asset industry, so through sort of securities and equities and funds. But a project that I work on quite closely with Ben is this metals tokenization. So yeah, pleased to be here today.
Oh, it's a pleasure having you. And now, since we're talking about this whole what's new thing here, because I know, Ben, you've been dying to kind of let the cat out of the bag, and it's like, I can't quite yet. But here we are. We got nickel and cobalt. I guess let me just kick it off. Like, why now, right? Like we started with uranium, we swapped things around, made sure that it was a much bigger platform to handle a lot more things. But now we have nickel and cobalt. Why those two now?
It's a great question to start with, Action. So I think, yeah, we always knew we were going to add more metals, and you're right, we alluded to it quite a lot. I think why nickel and cobalt and why is now the right time for that? I think really three reasons converged and sort of came to the fore around now, and the similar narratives play out to what we saw with uranium. So the supply story became a little bit more urgent. So a bit of background in 2025. So the DRC, or Democratic Republic of Congo, which produces about 3/4 of the world's cobalt, decided to impose an export ban and then replace that with quotas, so capping 2026 exports at less than half of the production in 24. And so what happened with that was cobalt prices more than doubled. Similarly, Indonesia then cut its nickel ore quota by 1/3. So both metals went from a market that was, in oversupply, quite frankly, and therefore not so interesting, to being policy-constrained strategic assets within that 18-month period that then makes the investment case much more interesting, but also moves them up the importance from a critical minerals list perspective for things like the EU and stuff. I think so. What went with that, which is the second factor, is that investor demand inevitably followed. So when a metal doubles in price, investors start asking, not unreasonably, how do I get exposure to that metal? And what a lot of investors have found, I'm sure, is that there's no clean way to own physical cobalt or nickel, although it wasn't until last Thursday. And so that access gap is exactly why we exist, right? And so the third factor was we were being asked about new metals, and our infrastructure was ready. So we had the model with uranium. We've got great partners, the likes of Archax. We did the hardest custody challenge in commodities with uranium. And so extending that to new metals was an execution step rather than something that we were rebuilding from scratch. And so that meant that when the market signal arrived and we saw some inbound questions, we could move and provide first of its kind access from a general investor perspective to physical metals that there are no comparable products on the market for.
So basically, it would have been okay. Everything would have been fine, but they decided to put that quota in. Now England had to beat them in football the other day. That's what I'm hearing, right?
That was how I was looking at it, putting aside the sweepstake that I had, which was for the Democratic Republic of Congo. That was my sweepstake team. But yeah, so it was almost the Metals.io bowl yesterday.
Too funny. But it's a blast actually getting to see what's happening around the globe. And, you know, a lot of these times we forget about how many countries are involved in the trading and the sourcing of so many different metals. And, you know, little things like the World Cup kind of bring it all together. Like, oh, what are these guys known for? And finally, people actually start waking up and going, oh, the world's a lot bigger than I thought it was. Which kind of brings me to you, Tim. If you can like shed some light here, like why are some of these metals actually becoming kind of increasingly important in today's economy?
Great question. They've always been important in some way, but the uses for them are growing dramatically. If you look at nickel, you know, nickel is the key metal in stainless steel. You know, so it's, you know, stainless steel. We don't get stainless steel without nickel. That's where most nickel goes to. But nickel is incredibly important in battery technology. So with the rollout of more EV, with the more EV revolutions, with, you know, the push to figure out how do you store solar power, how do you store wind power, you know, that's the big problem we've got with renewable energy at the moment, is how do you store it? Nuclear, you don't need to; it's always there. But when you look at the other green energies like wind and solar, etc., we need to store them. So nickel's a key metal in that technology, but it's also key in so many, as is cobalt actually. It's an ingredient in so many of the high-grade alloys that we need, whether it's for SpaceX, whether it's for GE or Rolls-Royce jet engines, for the aviation industry, both civilian and defense. These alloys are key components. So these metals really make the world go round. Cobalt, again, has got a really unique role. It's one of the key components in permanent magnets. And what is a permanent magnet? Well, a permanent magnet is actually just a magnet. But if you, it's basically they can power themselves. So this kind of technology is always taking us forward. But the other key component that everybody misses, talking about the World Cup and the size of the world's population is always growing. And what does that mean? It means more consumers and more consumers and more consumers. Therefore, we need more of these metals to help drive that consumption.
Well, that's such a great point. And I don't think people realize that until they're you know, met with more and more people, more and more nations, and realizing, you know, our size and how big we're actually getting out there. George, let me go off to you just to kind of get the ball rolling here. As far as, you know, kind of getting items that are tokenized, it's not always easy, and it does take competence, I guess, the best way to say it. And I've had so many conversations with Ben in regards to, yeah, we got to get legal. It's something that people forget about. It's like, it's kind of number one. You got to make sure things are actually compliant. We haven't seen a lot of these things tokenized. I mean, for crying out loud, uranium didn't have a spot price until, you know, Ben came around and started working on this thing. Do you see, you know, this tokenization route actually continuing as strong as it is, and including more and more, you know, commodities essentially?
Yeah, 100% is the short answer. I mean, our fundamental belief here at Archax, and I think it's sort of becoming a more widely spread opinion, is that all assets, financial assets, will move onto a blockchain. You know, it's started with crypto. That's just the first asset that exists on a blockchain, but it's a new rail that brings utility and efficiencies to assets versus their sort of off-chain analog counterparty. So actually, when, you know, I explain to friends and family, you know, the space I work in and blockchain and tokenization, this is a pretty great example of it, whereby you have a huge minimum lot size for some of these metals. You have multi-day settlement cycles, limited access to retail investor base. Whereas now, through this technology, we're able to expand these tokens to a global investor base, especially to the new generation of investors who want access to these things on their phones instantly. So it's bringing a product that was previously inaccessible, and it's a really good example of how the tech can do that. So I'm sure that we'll see this expanded through other asset classes, working with Ben and Tim on further products as well. As Ben said, we started last year with uranium, and that was the first, and had some hurdles, but we got there, and that was probably the most difficult. So now, as we have this structure in place with our sort of custody underneath it and tokenization, and now further distribution channels, I'm sure you'll see more.
Oh, I love to hear that. And I'll tell you, a lot of times people are really looking at the thing that they care about most, right? Gold was all the buzz for I don't know how long, and it's been, it's gotten some good returns, and I'm happy I had, something in there to show for it. But we're always looking at, some people are short-sighted when it comes to commodities as a whole. And it's like, please stay out of the game, if I may say so. But for those people that are really interested in the long-term benefits and really looking at, things that will essentially appreciate over time. I know that Tim kind of brought up the fact that, these items are only going to get more scarce with the population increase and the technologies that we're kind of using. And I'll open this up to any of you guys. What do you guys see as the long-term play here when it comes to commodities? Is it something that, what's going to be driving this demand? What's actually going to make these metals something that's necessary for people to, let's even say, talk about, right, on a daily basis? Because most people, nobody considers metals there. It's just something that sits in the background and they don't ever have to think about. Is there, other circumstances and scenarios that makes these, metals critical for a long-term demand?
Yeah, look, I think I'll go first and hopefully cover it to sort of lay the scene out. But I'm sure Tim certainly will. I'm sure we'll have some additional opinions. I think we've alluded to a few of them as we've gone through already. But there's a few different structural trends that are all pulling in the same direction, and that direction is exponential demand growth, right? And so the energy transition is one of those. I think EVs, of course, but as Tim said, energy storage, wind, solar, grid modernization, right? Even if you've got a coal, power plant, the modernization of the grid to make it more efficient to get into different places of a west, a state in the Western United States is still going to need more hard materials to support that. They're all minerals intensive. Renewable energy systems in particular, we're obviously just coming off the back of a heat wave here in the UK and Europe. We've got another one coming in. So I think the recognition of renewable energy and renewable energy systems is growing again, and therefore that they do require many more critical minerals than the fossil systems that they're supplementing right now and may eventually replace. Defense spending, defense systems are critical mineral intensive. Procurement's becoming increasingly strategic there, as well as thinking about procurement from a supply chain diversification perspective. One thing we may talk about later is the role that's somewhere like China plays in the procurement and refinement of these critical metals. And of course, the other bit that I would mention that would be remiss not to is the digital economy and AI. We all enjoy being able to use Claude and ChatGPT, and the demands for AI are ever increasing, but that creates a new engine of demand, right? In terms of, we talked about it a lot with nuclear, in power loads, grid expansion, transformers, backup storage. You see in the narrative around the whole S&P 500 change to be an AI story, right? AI stocks come off and Caterpillar comes off as well, because generators are being used to sort of as backup to support power stations. The IEA projects that global electricity demand is going to be about 3.7% just this year.
Wow.
And every bit of that infrastructure is metals hungry. And so the long term demand isn't going anywhere, and actually what you're going to see, in my belief, is a lot more strategic engagement at the national level as people look to secure supplies of these assets, given the criticality to what we've been talking about, as well as sort of how do you then diversify away from some of the dominant sources, not with, because you can't accept, given the criticality of these, some of the impacts of the price quotas and other things that I mentioned earlier around nickel and cobalt. So having a mechanism to allocate more capital more effectively to that diversification is something that I can see us at metals.io having a role to play.
Yeah, let me hop in if I may. So, actually, to your question, what's the long-term play here? Well, long-term play is only going to expand and get larger and larger. So, if you look at the auto industry, here in the UK now, we're looking at pushing to 20% EV sales. So 80% is still traditional, 20% is EV, and this isn't the leading country in Europe by any means for that, or in the world, but we're still up there. So every charging cable, that's 1 kilo of copper. Every car has got, how many kilos of nickel in the battery pack, how many, kilos of cobalt as well. So just the move to electrification of cars is a huge start. The move to re-electrify a lot of the train services in Europe, the move away from people being dependent on their own cars to Uber, to using, for short-term transportation, using trains for long-term transportation, the use of obviously aluminium and other alloys in the aviation industry, that's only expanding. If you look at the use of alloys, then the aging population, hip replacements, all of the surgery items, those are alloys, those are cobalt, those are nickel. So it doesn't matter which way you look. And that, by the way, that's just the developed world. Now look at the global south. The global south is the term referred to kind of south of the Middle East, etc. Mm-hmm. Africa, India. These are this next huge great expansion for humanity, where the trains are going to be, electrified trains across Africa. Africa's hardly got any trains at the moment.
Yeah.
So that's all got to be built. All that infrastructure has to go in, and it's going to be electrification. It's not going to be steam powered or diesel powered. It's going to be powered by electricity. So more electrification, more commodities. It's more aluminium. It's more copper. It's more nickel. It's more everything needs to be used. Air conditioning units. The push to urbanization in India and in Africa. We've seen what happened, and in South America. We've seen what happened in China over the last 40 years. Why will that not be replicated throughout Africa, throughout in the Indian subcontinent and elsewhere? So all of that is, a new apartment block. Well, guess what? It's still copper that is the wiring behind that for the electricity. You still need copper for the piping. You still need, the nickel for the stainless steel worktops. It's all going to mean that the case for metals is only going to get larger and larger.
Man, Tim, you are speaking my language. That's exactly the world that I live in day in and day out. I'm actually managing, myself and my partners, a brand new port out in Ivory Coast. So I see all of the demand. You're dead on. Like, the conversation is not about, oh, how big is it going to be? It's going to be, all right, can we have drones? Can we have surveillance? Can we have battery backups? Exactly like you're saying. So you're dead on when it comes to the emerging markets actually, being a big driver. As innovation kind of gets to them, they're not doing the regular step 1, 2, 3. They might have been in step 1. Now they're going to go, what, why metal with all this boring stuff? Let's go out and get the latest and best technology. Let's go ahead and skip some steps, which again, metals are at the heart of it.
Can I just also, actually, apologies to interrupt you, but this is what Ben has managed. This is what the team at metals.io have managed to do. That now, instead of waiting for a stock exchange to come up somewhere in the middle of the world where you can now go and buy a structured product, you can buy this, or you can buy that. Anybody with a smartphone, be they in India, be they in Africa, be they in South America, can now actually participate in the global investment community by just buying a kilo of cobalt, if that's what they want to do. Not only, this helps bring development to the emerging markets, but it's also helping to bring, good, solid, strong, real world asset investment opportunities to emerging markets as well, where they haven't really had access to anything at all, at best a bank savings account. Now they can actually allocate money if they really want to into nickel, into copper, into cobalt, into lithium, whatever the token happens to be. And that's not only is it happening for the first time for them, this is what I think a lot of people miss on what we've done, or what Trillion R checks have done with this, with Metals.io have done with this, is that this is the first time ever people have been able to buy it. You've been able to buy spot gold via an ETF on the stock exchange for 21 years. You've never been able to buy these metals before. Institutional investor, private investor, you've never had access before. And that's really revolutionary.
No, I completely agree with you. So let's talk about this, because people have always been interested in precious metals, right? I'm the nerd that thinks that industrial metals are pretty precious to me. Like, how should investors be looking at this? Is there a different mindset when looking at, your good old, silver and gold versus your base metals that are necessary for the alloys that you guys are talking about?
I'm really a little bit nerdy here because I occasionally use my CFA charter that I spent 3 years getting, and so I think if I look at it from a portfolio view, I think it's not an either or decision, right? In terms of precious metals versus industrial metals, I think it's they've got different jobs. So if I think about that, the best framing is probably by function rather than by category into precious or industrial metals. And so precious metals, gold primarily, are sort of more like monetary assets, right? Their value comes from scarcity, trust, and their role as a store of value. So, and we see that gold performs well and has performed well when confidence in currencies and concerns of debasement weaken. Confidence in currencies weakens, you get inflation, geopolitical shocks, all of that flight to quality trade is still playing out. Industrial metals, on the other hand, are much more demand assets. So nickel, cobalt, copper, their value comes from what the economy physically needs to build. And so when the economy is in growth mode, demand for these assets increases. So they perform best when investment, manufacturing, technology adoption, all accelerate. So they're your growth exposure. And often the two are uncorrelated. So, which is why, if I, again, not to get too nerdy, kind of look at it, holding both makes sense. So in a crisis, gold rises while industrial metals may fall, and vice versa. So actually, to recap, I think a portfolio holding both is going to be a little bit better positioned potentially, and people should do their own research for their own portfolios, but positions you a little bit better for either regime. And that's precisely why we wanted to take a single asset platform like Uranium.io into the multi-metal platform of being Metals.io, and being able to do that at retail scale. And of course, one thing to worth that knowledge, just that warning, and the difference is industrial metals typically have been a lot more cyclical because they're demand driven, and therefore a lot more volatile than something like gold, because they're not that or haven't been that investable. The markets aren't as deep and liquid, and also the nature of how they've performed historically means that there is a bit more volatility. But that's true of investing in stocks versus bonds as well, So I think having a single place to be able to articulate both sides of that portfolio perspective is really compelling, and that's why we're driving towards what we are on Metals.io.
Yeah, and I was just going to add, we've been talking a lot about the demand for the underlying metals themselves, but I think the demand for the tokens, i.e. an investable way, right, to get access to these, because we live in this sort of age of information and globalization where, whereas, your grandparents and generations before would have parked, cash under the mattress, we're all now sort of seeing these multiples that AI firms are getting, and, the ability to dig into these companies and understand the different ways that, they're going to grow and develop, and then, the requirements for them to expand, such as batteries. Now for investors to be able to buy some physical cobalt So it's not just demand for the underlying metal where we see its needs. It's actually people couldn't access these things. So being able to access them all on one platform, whereas Ben said gold has been an investable asset, people now want to be able to access the different constituent parts and dig into the different resources that are fueling this sort of explosion, specifically in AI as well.
We'll talk about this new wave here. So does that mean that we're kind of seeing a new commodity investment cycle, or are these metals always going to be individual, cycles themselves?
I think from my point of view, just sort of going slightly above that, and not specifically in commodities, I won't go to Tim for that, but I certainly think we're in the sort of new wave of where, rather than hiring a sort of wealth manager and separating oneself from those decisions, this technology, and there's a huge move towards having a mobile app where I am able to manage my cash. These sort of neobanks as well, where I can have my salary coming straight into it. I can automate, how much I'm putting into treasuries or how much I'm investing into gold, into these precious metals, into funds. This ability to have such a diversified portfolio, I think that you'll see these different products coming up that break apart this previous approach to investing. But maybe Tim for the commodity side.
Man, yeah, please, Tim.
Yeah, look, I think that's the one thing. So when you look at mining, for example, most miners are not specialist miners. In fact, most of the only real specialist miners are uranium miners and potentially gold miners and silver miners. Most miners are mining a ton of ore, and they strip it out, and they've got a bit of copper, they've got a bit of gold, they've got a bit of nickel, they've got a bit of tin, and they process it and they sell it. So there's metal coming online, whether the price is going up or the price is going down. It doesn't really matter, because if they can make a profit out of selling whatever metals they get out of that ton of ore, they may be selling tin at a loss, they may be selling a little bit of the nickel at the loss, but they're making more money on the copper, they're making money on the cobalt, et cetera, et cetera. So that's how the flow happens. What I would think is what is very different to base metals, industrial metals, to precious metals, is that precious metals have got very, very defined roles in the economy. What I mean by that is, if you're looking at platinum group metals, palladium is the key component in gasoline engine catalytic converters. Really important, particularly when you realize that today you're probably seeing more hybrid sales than you are pure EV sales. Therefore, there's a bigger loading actually of palladium for legal reasons into the catalytic converter to make sure you're always cleaning the pollution immediately. If you look at, they've got some very defined roles, and again, in medical research, in medical services, et cetera, et cetera. Silver, a lot of uses, solar panels, et cetera. So it's got some very defined, but if you look at them as a whole, it's industrial metals that drive inflation. Precious metals don't drive inflation. You can live your whole life without buying any gold. It's not going to have any impact on you at all. But if you try and you can't live your life without copper, without nickel, without cobalt, without these other metals and alloys. They are the key components of what drives the global economy by their very nature, which means they are the key components in inflation. So from an inflation point of view, a diversified basket of these metals can really help you fight inflation in your portfolio. And I think that's something that people don't necessarily understand about the base metals per se. Again, when you're looking at the commodities as a whole and commodities in general, there's actually a processing time, and that processing time can actually take quite long. And a lot of the commodities which we're using, in particular, obviously in the West, but particularly say in Europe, they don't come from Europe. They come from Africa, or they come from South America, or they come from Australia, from North America, from Indonesia. So you've got this huge transshipment as well. So you don't really have a just-in-time solution if you're manufacturing in Europe or consuming in Europe. You need to be pre-ordering your metal at least 1 year to 1.5 years ahead. So the kind of the demand side, as George said as well, we've been looking a lot at the demand side, but the demand side's pretty much set and quite predictable. but it's the mine supply, and this is what I love about commodities. You know, to borrow a term from Ben, this is my turn to be nerdy. This is what I love about commodities. You know, you can say demand for nickel next year will be down 3%. But if supply is down 10%, nickel's going to the moon. It doesn't matter because there's still going to be more buyers than sellers. So we've really got to look at the supply side. And as Ben mentioned before about the DRC, you know, putting restrictions on cobalt, you know, the political risk in commodities is very high, and that can really drive the price as well. Nobody knew that cobalt was going to get restricted in February last year, and all of a sudden, overnight, it happened. So that's what's kind of really interesting about commodities as well. You've got to look at the supply side. You can't just look at demand.
And you know, talking about the supply side of things, like having that understanding definitely goes a long way. Now we're seeing this gap being bridged, right? Because like you're saying, a lot of these metals are kind of dealt with on a yearly basis. It's people actually using it. But now that the markets are essentially opening up, thanks to Metal.io, for people to actually acquire them, you know, by themselves without that middleman. And you know, just a quick side note on wealth managers, like 96 to 97% of them lose in comparison to the S&P 500. So I never am using one of those guys. I like managing my own money, which is why, you know, having the access that you guys are able to provide, Ben, is, you know, incredible. How does this bridging of, you know, traditional commodities with digital finance not only happen, but why do you think it makes sense for the, you know, the investors that are coming online these days?
Yeah, look, I think George touched on a lot of the key points earlier in terms of like, you've got to meet them to build anything successful, right? Not just in what we do, but in any product. You've got to meet the market where it is and where the market demand is. And I think everyone has their expectations set in globally around the experience they have day to day with any part of society, seemingly now being done through their almost instantaneously and through their phone. And so, you know, what's really important is there is enough innovation that could be done in the traditional finance markets and traditional capital markets because these products have been inaccessible, right? You could do that. But for us, we sit at exactly that junction between DeFi or digital finance, you know, decentralized finance, digital finance, as well as them working with experts and the like and advisors like Tim. So, and we want to build for both sides deliberately. So, you know, on the traditional side, everything about our structure would be recognizable to conventional finance and even those in the supply chain for commodities, right? So the names of the custodians and the storage providers that we'd use, the regulated partners that are FCA authorized, like Archax, the KYC requirements, the kind of proof of and evidence of storage. But bridging that with what you get on the digital side is what then makes it and turbocharges how useful this is to the individual investor, right? So, and not just the individual investor. So they live live on chain. They're tradable 24/7 globally. They're transferable in seconds, composable with DeFi, which starts as an individual piece in terms of that composability with DeFi, but actually becomes quite important if you can do that at scale and get better balance sheet efficiency for the people in the supply chain. Because, you know, actually supply side investment, so allocation to mining and the like, is down in these critical minerals compared to 2023 if you look at IEA estimates. And so, you know, actually enabling and providing solutions for better balance sheet efficiency, albeit we're starting with the individual investor. Look at what we did with uranium, with enabling you to pledge that as collateral and therefore borrow against it and reinvest. That bridge from either world can being able to use the platform without you leaving their comfort zone. Because if you can use a banking app, you can use metals.io. So traditional investor on boards like they're opening a brokerage account and never touches a wallet. A crypto investor can connect their existing wallet and get that full on-chain functionality and experience, which are the same assets held in the same way, but you've got two different access. And actually where we sit is trying to meet the market where it is, where eventually we think DeFi will no longer be a thing and people will just talk about finance with that composability. But right now we see it as two different access points, but meeting the needs of all of the different audience requirements for that.
Now, I want to make sure I give everybody. Go ahead, Sam, please.
I was just going to say, just to go back to something you were talking about just a moment ago. You speak to some of the miners, and when they understand what these tokens do, and there is case history for this, for what was done with the Platinum Group Metal ETFs. The miners actually support this, and the World Gold Council, basically sponsored GLD in the States 21 years ago. The miners weren't really sure. They weren't sure this was a good idea. That transformed the gold industry, because you've got this big fund sitting there, always buying gold,
Mm-hmm.
and that because basically when commodity prices are low, that's when investors come in. So investors now being able to buy nickel, being able to buy copper, cobalt, they can buy when they think the price is low. And as the price rises, they can then sell, because that's what investors do. We're doing it to make a profit. That helps smooth the kind of the boom or bust cycle that you get in commodities, because investors previously haven't been able to access the market. So investors come in, they provide liquidity in falling markets, because we're buyers in falling markets. But demand in falling markets. We're providing liquidity in rising markets, because now we're realizing our profit. And the mining industry actually appreciate that.
I couldn't agree more. And just to add sort of anecdotally to that, I was at a breakfast yesterday that was between the EU and Australia, talking about critical minerals sort of purchasing, given the MOU that was signed earlier this year. And the big takeaway from that, and the big theme from that, is, well, how do we get more capital allocated into the supply side, i.e. mining? And basically it came down to, well, making sure you've got the offtakes. The alternative here is build a liquid and deep secondary market, and you need to worry less about having the private offtakes, right? You need to worry less about where your offtake's coming from, because you've got a market there to sell into at a given point in time that also gives you transparent pricing, which makes all of those analysts on the bank side happy, because they can model those prices till their heart's content and come up with a risk-adjusted return for the capital allocation. So I think there is a larger benefit to what we're doing for sure, as these markets become more investable, and we're playing a role in that. That really just emphasizes that no one's ever I say it quite a lot, but no one's ever complained that having more participants in a market is a bad thing. If you look at the equities market or the bond markets or anything else, commodities have just lagged behind that. And now actually what we're doing is bringing what the market has realized is the best tech and best infrastructure to these markets. And we can leapfrog all of those other traditional development stages that other asset classes spent decades going through.
And I see this around the globe as well, where people are trying to hold on to things more than they were before. Like a perfect example is I work with a gold bot out in Ghana. They're essentially like the Ghana's gold board that manages all of their gold assets, and they just struck a deal to buy 30% off of large miners. And what they're looking to do with it is actually not sell it. They're looking to hold on and increase reserves. So talk about scarcity here. It's one of those things that people are just nation states are saying, we're producing a bunch of gold. Why are we sending it all out? I mean, it goes back to what we're talking about, with Congo and how they're restricting, the output of these metals. They're not only starting to catch on, they're seeing the value. I mean, if other people are buying these things like crazy, they want to hold on to it as well. And having more markets is always, to me, a benefit, right? It increases the accessibility. And that's always, guys, I grew up in a third world country. I literally had nothing. I had stocks, like, forget that. Like, I would have never been able to access anything. So like, I've lived this, I've experienced it, and having the access definitely changes things, especially for me, knowing where, and how it impacts people all over the globe. George, if you don't mind me going to you real quick, where does blockchain come into all of this? Like, is there a benefit to using, blockchain, DLT technology, really to anything beyond the transparency? Because I love how people say, blockchain makes everything so transparent. And it's like, how do I see that? Like, I've never seen what that actually even looks like.
Yeah, I mean, we see a lot of tokenization for the sake of it, which is good for the industry and adoption and good projects, but it really has to have a point, right? If an existing industry or an existing asset is well serviced and there's no real benefit, then that'll come. But right now, I think where blockchain comes in here is people list off the benefits of bringing liquidity, fractionalization, settlement, and like all of those are true of these products, right? Rather than an investor, right, having to buy $10 million of uranium, they can now buy $1. Rather than it taking 30 days to settle to an account which they probably can't open, they now can, because we've been able to buy that. And so Archax holds the underlying on trust for the end investor. So they have a token, right, that represents the physical metal that we are holding on their behalf. The tokens allow that to happen. Ben, I can send Ben right now from my wallet like $1 worth of any of these metals. I think that's what this tech brings, and I genuinely do use these products as the sort of the example of explaining blockchain and explaining the benefits. Because as you say, there's a lot of promise and a lot of talk, and unless you can really bring it, and it's great to see that all of those are true of this.
I love what you said about people just bringing things on chain or pretending they're on chain just for the sake of it. Where does regulation kind of play a role in all of this, especially in the future of tokenized commodities? Because I think that might have an impact, right?
Yeah, I mean, it's a fundamental part of us at Archax. We approach this space from a regulation first view. I think especially for these products where you have a physical asset that you can't directly see through on chain. That's literally impossible. You have an on chain record. You have to have some proof or some certainty that what you're holding in your wallet or in your account or buying represents something that's held beneath it, because that you need to have that credibility to say, right, well, I've issued £1 million worth of nickel. Well, that's being held by Archax, a regulated custodian. That's not new. That's just that we're sitting under the existing framework and regulation in the FCA in the UK. So there's a lot of products out there that you might offer things that maybe aren't necessarily sitting underneath them, sort of assets that claim to be something that they aren't. So it's a crucial sort of underpinning part of these products for sure, and certainly something that we think is crucial for this industry to develop, not just in the commodity space, but retail investor protection for institutional adoption. Institutions won't come into this space unless they're dealing with credible counterparties. That's where the capital ultimately flows from, but they're not going to do it with unregulated sort of cowboy players out in the world who are unregulated and are issuing products that aren't really what they are.
No, that has been a problem, definitely, because people want to be so at the cutting edge of technology that they forget about all of the the hoops they are supposed to jump through to make sure that things are compliant. You mentioned something important here that I hate being that guy that says that retail matters, but only a little bit, right? Like, I love retail, I love empowering people, but at the end of the day, like, one deal that I've made with between Poland and Ghana, for example, Goldbot, like, paid for lots of vacations as opposed to one retail investor can't do that for me. So it's kind of important for us to also think about the institutions that are in all of this, that how are we actually managing that? Like, what does institutional infrastructure look like, and how important is it for the long-term adoption of these platforms? Because we can have thousands of retail investors come in, and still one institution will outbuy them time and time again, simply because they have more access to funds, their demands are higher. Where does that fit in? Ben, George, Tim, any of you guys?
Yeah, I think the institutional adoption is. I'll start off and keep it quite short, and then I'm sure Tim and George have got views as well. But like, institutional adoption is absolutely crucial for the success of everything that we're building. But I think it goes back to a lot of what George was saying, right? Is that what we're doing here is plugging into that well-recognized, familiar set of counterparties, regulation capabilities to ensure that institutions are comfortable, and then it's our job to educate them on the additional benefits they get from being able to transact with more modern infrastructure. So when an investor sees Cameco being used as the storage facility or converter for uranium, they don't need to evaluate our claim because they've probably already got a Cameco account, right, and understand what that means.
Yeah.
Same for Archax in terms of the tokenization piece and the trustee piece. And so every institutional counterparty in the stack is credibility that we've not had to build from scratch, but we've leveraged. But what it does mean, and where I think we've set ourselves apart, is we've been willing to lean into that institutional infrastructure. So institutional standards of segregation of assets, audit, operational resilience. But that also means that you need to lean into patience as well. And that's where a lot of the industry today in digital assets and RWAs have struggled. We've really had a lot of institutional conversations over the last 18 to 20 months, as George will attest to on the uranium side. But until you've built that track record of being around for 18 to 20 months, the meaningful direction and moving the needle on those doesn't really start until now. So it's that old adage of with institutions, it takes a lot of time to build and it takes a lot of years to become an overnight success. But I truly believe that we're kind of getting there. So in short, retail adoption gets you started and enables you to prove that everything works. But institutional infrastructure and engagement is what keeps you standing 10 years later, to exactly your example between Poland and Ghana, right? That's really where it's going to make the difference in the depth of those markets. That's my perspective.
There has to be purpose as well, right? That's why I think there's quite clearly a use case in these metal tokens for retail access, global access, to be able to invest, $5, $100 into these. But we can see that for institutions to do this, they already can and have been able to access these products in other ways, right? So the retail part is one, but if they're going to come into these products, there has to be a reason, there has to be purpose. And again, blockchain can bring that functionality and features. So being able to settle instantly, being able to automatically, lend out, half a lot size of uranium for stable coins, which more and more people are accepting, can be used as cash, fiat cash, then that's where they'll come, because it's not just, okay, they're going to move on to blockchain because that's where the industry is going, and narrative and sort of high level idea. There has to be a reason for them to shift over. And I think that's what we're doing quite well with these products, is it's not just expanding out to a more global retail investor base. It's the utility of the tokens, utility of the product. What can I do with it? Can I lend it? Can I send it instantly? Can I sort of automate funds and the buy and sell at different rates? That's where it gets interesting for institutions.
I think also, just to put in my 2 pence worth, I think that when Ben and I first started speaking, metals.io, that these tokens have been designed to replicate what you would buy on a stock exchange. So the proof of reserves, you can click on a button, you can see at the moment, the Steinweg release document saying that, these drums of cobalt are being held, and this is KLK brands, et cetera, this is the chemical makeup. So to make sure that, if you can set the bar high enough and say, right, you need transparency, you need accountability. And as both Ben and George have talked about, the regulation is imperative, because we want to set the bar high enough that if anybody comes behind us, they have to do at least what we've done, if not better. Because if you can do that, you can then get some kind of a more global market going. If all tokens are to the same standard, when I say standard, I mean the kind of the specification of the metal that's held, the chemical makeup of the chemical analysis of the metal, all that can be embedded into the token. So any buyer knows what they're getting. And that's how you justify the use of the global prices as well. But regulation is imperative. And to George's point, we've taken something which would, if it was a security, would be regulated. And now it's been put on the blockchain. But by putting it on the blockchain, there's now an immutable record. So if anything, the token is actually better regulated entity, because nobody can go in and change any of that information without leaving a whole footprint of exactly what they've done. So I think in many ways the token is a better and more secure investment structure for retail and therefore for institutional than the existing securities markets are.
Yeah, it takes paper trading to a whole new level, right? With the traceability and who did what and where things are going. I completely agree with you, Tim. So if you guys had to like sum it up, what does this successful collaboration between your TradFi, right, your traditional financing, and this blockchain powered infrastructure, what does that look like? Is it what you were saying, George, in regards to using stables to settle things? Where do we draw the line of like something being, successful, having that crossover?
Yeah, for sure. I think there's innovation in this space, in digital asset space, and there has been for years in crypto, and that's brilliant in many ways. But we've certainly seen events in the industry that have caused issues and investors to stray away from it, and that's perfectly fair. But I think when we get regulated players coming in, and you get a further breadth of products from credible issuers on credible platforms, just think that the benefit that we'll see when blockchain rails are used more broadly, right, where currently there's this interchange where I'm going to have to move off chain to on chain. That starts with cash, and then I have to go and get stable coins, and then I can buy these. So slowly, right, we work more onto the chain, because the players in the space are more credible, because the regulation is forming around us that allow issuers to create a token under a certain rule book, right, without creating that rule book themselves. I think that the space is adopting quite quickly over the past couple of years, at least, where regs are important, and people are realizing that more and more often. But also, luckily for us, people are realizing that we, did it at the start, got regulated in the FCA, under the FCA in the UK, and slowly, we've seen the bad players weeded out, and more interesting products, and investor appetite to come and buy these products because they can trust where they're coming from and they can see all the way through them.
Yeah, look, I think I'd agree with everything George says. I think really successful collaboration, dare I say, looks pretty much like what we've been doing, right? So you can bring from TradFi or traditional industry the custody expertise, the regulatory relationships, the distribution, the decades of trust, and you combine that with the settlement speed, fractionalization, global access, and composability that only blockchain can do. That really is when you start to sort of move the needle on being able to say that this is just better. It's just a better way of doing things without losing all of the stuff that was there for good reason and that has evolved over the last 4 or 5 decades to protect investors, to protect participants. I think when that blend becomes near seamless, and the regulatory environment is the overarching point that will enable that to be driven, right? And I'm pleased that MiCA, the Clarity Act, and everything seems to be heading in a similar direction of we just need to treat these assets in the same way. Just because you happen to put something on a blockchain doesn't change the nature of it. Everyone on this webinar that's participated knows that's been my biggest bugbear for the last 12 months is articulating to people that uranium on chain is no different to uranium off chain. It's just easier to get hold of, but not take physical delivery of, most importantly, because we back into the drop. Is sort of where I see it working. I think to just really illustrate that, I think the failed model where it doesn't work is the other extreme. So crypto projects improvising custody or securitization structures, or traditional institutions bolting a token onto legacy infrastructure, calling it innovation, but having a huge back office team in some outsourced location, having to work 24 hours a day to sort of update the manual records. So the successful model is that genuine division of labor, and it's kind of already visible, I think, through what we've done, through what other projects have done. BlackRock is a good example in terms of partnering with digital native infrastructure for BUIDL, and Archax is sort of you're able to do that there as well. But they're looking at taking and building that best of breed model in the same way that we are. if it's not broke, you don't need to fix it. But things are broke and things can be improved. That's where tokenization and blockchain technology really comes into its own.
Go ahead.
Actually, just one last point, because I think what blockchain allows the issuer to do, for Metals.io's point of view, is you can put a lot more information into a token than you can put into anything else. You can actually embed the chemical analysis, you can embed location, you can embed gross weight, fine weight. You can also, if you had the desire, you can embed the carbon impact. You can actually put carbon impact into the token and say, if you buy this copper, this cobalt, this nickel, this tin, this zinc, you're buying this come from this mine, and this mine is rated as one of the top cleanest mines in the world and has got one of the lowest carbon impacts. So you've got therefore, if you ever get a bifurcation of the market of people being prepared to pay more for green metal, you've already got a token which qualifies as a green investment. And all that is now an immutable record of that token. So it's embedded there forever.
I'm glad all of you guys bit into that question, because it allows me to ask the follow-up. What are we looking for? Like, what are the milestones that we still need to hit for us to consider, tokenized commodities a success, for them to become, mainstream, I guess you can say?
Okay, happy to go first with that, because your question kind of sums it up quite nicely in that you wouldn't be saying tokenized commodities. I think we're at this age of innovation, so tokenized assets is obviously a huge phrase, and really it's just issuance of products, and that'll become the standard. Once we're there, then yeah, we're away.
I think George has stolen a march on the kind of key point there. But I think a couple of other things in terms of specific milestones that I would look at. I think a tier one producer coming and issuing output on chain directly. So not a partnership press release, or not someone having to go in and purchase metal that's already been sold elsewhere, but someone saying this is the offtake and this is kind of, we're going to issue it straight to a tokenized output because it's a better distribution channel. So that supply side validation is one thing. I think the other key thing I'd look at is institutional custody as standard. So prime brokers just being able to hold tokenized metals for clients alongside equities and bonds as a routine thing, not a special project. That once that operational barrier goes, I think that's where we'll really see the adoption. So banks like Morgan Stanley moving to talk about launching their own wallet it makes that something that's much closer than we think. And I think once we get to that, that's really where we move away from DeFi, TradFi, and just talk about finance. And I think that's really where, much in the same way we've talked about any digital asset, that's an RWA, that's really where these things become mainstream.
I'd agree with exactly what Ben said. If we can get tier one adoption, then to be honest, we will already be there. Tier one adoption is the benchmark. That's what you want to really see, and that means we've managed to move from a traditional financing model to a kind of a more digital and 21st century model to take us forward.
No, I love that. And guys, this hour flew by. Thank you all so much for your time. Thank you so much for, pitching in not only the thoughts, ideas, but the insight that I am always so keen on learning. Tim, do you have any final comments before we close out today?
No, just really excited. This is a unique platform, and these two metals are just the beginning. And I'm very grateful to Metals.io, to Ben, to Archex for everything that they're doing, and looking forward to doing more.
I love it. Talking about final comments, George, anything from Archex as well?
I suppose, as Tim said, watch this space. We've got a structure here that we can replicate through. There's no reason why we can't expand the products out. So I think this is one to watch.
Phenomenal. Ben, close us out and let people know where they can find out more about metals.
Yeah, look, super straightforward. We spend a lot of time thinking about how do we make it as easy to access, and the best way to do that is go to metals.io, have an explore, and it really is less than 10 minutes, and you can own nickel, cobalt, uranium, gold, other rare earth metals, or just have a play around and see what's there and get to grips with it. Obviously, we're on X as well, so Metals Official is the handle that you can follow to see any upcoming announcements on our side, of which I'm pleased to say there are going to be plenty over the next month, which are really exciting.
That's awesome, man. Well, guys, thank you so much. It's been phenomenal. Don't forget about my niobium, okay? I'm having trouble sourcing anything over there with that, so keep that in mind. I appreciate y'all so much. It's been a phenomenal conversation. And if you guys are listening to us, make sure you guys are sharing this thing out and getting more people involved, because that's how we move markets. We ensure that more people know about what's going on and the access that these guys have been able to provide. Thank y'all so much. It's been a phenomenal conversation. I can't wait to do it again.
Thank you.
Brilliant.
Thanks.
Thank you.
Bye-bye. Bye.
Appreciate it.
Thanks, everybody.
Hey, what's up?
But it's not something Gensio is afraid of.
If you want to survive, you got to build a house.
We do not understand that we do not have. Ladies and gentlemen,
Rebecca's Gensio Media House.
Oswald, thanks so much for joining us today.